So I think the 4-year cycle doesn't really make sense anymore in the sense that it used to really matter because the new supply growth was significant. And so cutting that new supply growth in half was a really big event. And so it kind of gave us a natural 4-year cycle. Now, the supply growth is so low that it doesn't really change a ton. And the much bigger force is, if you raise the price, you get existing holders to sell, or some of them. You get this kind of unlocking of older coins that naturally happens when you have a really big price jump. It's kind of going through its distribution phase.
Bitcoin didn't fail this cycle. The framework many investors relied on did. The familiar 4-year rhythm that once defined Bitcoin's booms and busts is quietly breaking down, not because Bitcoin is weaker, but because it's older, larger, and more mature. Supply shocks matter far less when new issuance is already low. What matters now is behavior. Long-term holders taking profits, reallocating wealth, and distributing coins back into the market as price rises. That shift alone explains why this cycle feels slower, heavier, and far less explosive than past runs. This is why price action has stalled despite record adoption, ETFs, and growing institutional interest. Bitcoin is no longer a thin market dominated by miners and speculators. It's a global asset held by people who bought years ago, people who now diversify, rebalance, and make real-world financial decisions. The result isn't the end of Bitcoin's upside, but the end of automatic, clock-driven bull markets. The perspective guiding this analysis comes from Lyn Alden, one of the most respected macro analysts in the world. Alden is known for her deep research into global liquidity cycles, fiscal dominance, monetary policy, and long-term Bitcoin adoption. Unlike short-term market commentators, she focuses on structural forces, debt, demographics, and incentives, and how they quietly shape asset prices over decades, not months. In her latest interview, Alden lays out why currency debasement is no longer optional, why her now famous phrase, "nothing stops this train," defines the current macro regime, and how Bitcoin fits into a world trapped by fiscal dominance and endless deficits. If you want to understand why the next liquidity cycle could reshape crypto markets in ways most investors aren't prepared for, make sure to like the video, subscribe to the channel, and keep watching. Thanks, and enjoy the video.
So that was originally a quote from Breaking Bad, the TV show. The character Walter White says it. In context, he's basically saying that they're doing something dangerous and risky, and his allies are trying to get him to stop, and he's like, no, nothing stops this train. I initially used that to refer to the U.S. government, basically that there's virtually nothing that's going to cease their very large fiscal deficits. That we are in an era of fiscal dominance, and that it is pretty structural, and it was way more embedded than most people think. And a big part of my macro research, even before that particular meme, I think I used that term for the first time in 2023, but I became kind of known before that, going back to like 2019, for focusing more on fiscal policy and fiscal impacts on macro, whereas a lot of people were focused on monetary stuff. And so that's kind of been a core part of my research for quite a while. The meme kind of took on a life of its own, and so now it's kind of everywhere, which is fun. It puts a name to what's happening. You can talk about fiscal dominance all you want, but when you say nothing stops this train, it's more memorable. And yeah, basically refers to the fact that this U.S. and to some extent the developed world, but especially the U.S. is locked into a state of large fiscal deficits almost regardless of what they do, for multiple kind of intertwined reasons, and that this has already had big macro implications, and then for the foreseeable future, any sort of investable time horizon will continue to have pretty significant investing in societal economic implications.
So that means the debt is insolvent. What are those implications?
Well, yeah, the implications are basically, and this is already partially played out, that the sovereign debt on a purchasing power basis is insolvent, meaning that, generally speaking, because the debts are denominated in their own currency, bondholders will always get every unit that they're owed. It's just those units will buy less than when those promises were originally made, so they default through pretty significant debasement. It generally has a underlying inflationary component to it when you're running 6-7% of GDP deficits every single year like clockwork, that tends to have an impact. And it contributes to the kind of K-shaped or two-speed economy we have, which is that those on the right side of those deficits, the receiving side of those deficits, generally speaking, older Americans, or that the healthcare industry and their workers, or the defense industry and their workers, that money's kind of flowing out to them, and it's causing an increase in the money supply. It's causing kind of this debasement that's happening. And there are others that are not really on the receiving side of that, but as the Fed tries to reduce inflation, they stick to somewhat tight monetary policy, and they're on the wrong side of that. So if someone's like a young working family trying to buy a house right now, they're being negatively impacted by the deficits because they're not really receiving much, if anything. They're net taxpayers, and then they're on the wrong side of the tight monetary policy that's trying to correct for the inflation that Fiscal caused. And so it kind of creates, it's just a very kind of messy situation. And basically what happens is this is the result of accumulated decisions. So we've structured entitlement systems in a way that they kind of assume that every generation will be bigger than the prior generation. And so, as demographics slows down and ages, the math doesn't really work. If there's fewer people per retiree than is economically kind of sustainable, puts a ton of pressure and stress on the system. Some of our food and healthcare decisions are extraordinarily expensive and deleterious. The kind of structure of the global reserve currency plays into this. That's more complicated kind of discussion in its own right, but kind of one of the costs of the system is in exchange for running the reserve currency, the U.S. gets deindustrialized, and kind of gets kind of forced into this kind of fiscal policy at this stage. And these things are, we've had multiple kind of expensive wars that didn't really go anywhere, other than, adding to our debt and adding to our interest expense. And so these are multi-decade decisions in the making. And basically we have a public ledger, both in the US and globally. That ledger's not really solvent, so they have to start kind of defaulting on certain things. And so instead of defaulting nominally on debt or on obligations, to seniors or healthcare and things like that, they instead generally default more toward debasement. And the deficit is kind of like the error correction. It's kind of like the untreated error in the system. And that's why it's going to persist for quite a while, because these errors are not going to be corrected anytime soon. And that's how public ledgers basically leak, is through debasement.
What you're saying is it's going to be a gradual print as they increase the money supply.
Yeah, I think most likely. And so far that's what's playing out, which is, we had this kind of period where they tried to tighten the balance sheet. There were kind of limits to how much they could do that without the consequence they don't want. And so now they're, even though inflation's still above target, the way they measure it, they're shifting toward balance sheet increases. And those are kind of going to go as far as the eye can see. And they're not doing kind of a ton of money printing compared to, say, what we saw in 2020, 2021. And they're not doing it for the purposes of economic stimulus. They're doing it to kind of keep the wheels on the cart in the financial system, and to kind of, increase the base layer to allow the broader money layer to remain money good. And this kind of moderate scenario just kind of keeps this fiscal situation going. It keeps the train going for more quarters, more years. And again, you can occasionally get punctuated by a little mini crisis where you print a little faster for a period of time. But basically, I think that's kind of the more of the slow bleed scenario that we're on. So if it was as easy as 2020, where they're just going to print a gajillion dollars at once, then you pretty much buy everything that's not nailed down, and it'll generally do quite well. In a more of a gradual print scenario, it's a little bit harder investing environment because it's a little bit more stagflationary. Assets are not guaranteed to go up because some things that are overvalued can still go down, even as the money supply is increasing, just because the scale of that overvaluation can be as big or larger than the money supply growth for a handful of years. And so it's a little bit of a tricky investing environment, but it still really points in the same direction, which is you want to own scarce assets that are not bubble priced, in terms of depending on what asset class you're looking at. Equities would be like earnings multiples. For like hard assets, it'd be like just how crowded is it basically among the investor class. You want to look for things that are not super crowded and that are scarce and attractive and long term likely to appreciate, and try to be on the right side of that as much as you can.
Alden's macro framework sets the stage for everything that follows. When governments are locked into persistent deficits, central banks lose the freedom to truly tighten financial conditions. Liquidity doesn't disappear. It changes form, pace, and direction. This environment doesn't produce clean, euphoric bull runs or dramatic crashes. Instead, it creates uneven markets where capital rotates slowly, valuations matter more, and scarcity alone isn't enough. And it's within this backdrop of fiscal dominance, gradual liquidity expansion, and rising systemic stress that Bitcoin's role becomes clearer, more complex, and far more consequential over the long term. That brings us directly into Alden's thoughts on Bitcoin, fiat systems, and what happens when these two worlds increasingly collide.
Jeff Booth says that fiat and Bitcoin cannot exist long-term on the same rails. So, and he says that leaders like Michael Saylor will eventually need to choose their rail. Do you agree with this?
Well, yeah, I mean, I think it depends on time horizon, and it depends on how successful Bitcoin is. Gold and fiat have been able to coexist for many decades. Bitcoin is kind of a faster, harder gold, as long as Jeff Booth would say, as long as it remains decentralized and secure, then it's basically kind of the apex predator of monies. And kind of like how dollars can crowd out developing market currencies, Bitcoin can eventually crowd out the dollar. We're talking, orders of magnitude difference here. So Bitcoin, depending on price action, something like a $2 trillion network. You're up against a minimum tens of trillions network, but really when you include all the bond markets and everything, it's more like a hundreds of trillions network. These ledgers, these powers, have the ability to tax other assets. They have the ability to declare things legal tender. They can put pressure on liquidity of systems, so they might not be able to harm the asset itself, like something like gold or Bitcoin, but they can say, well, if you own it, we're going to do our best to surveil that fact and tax it and slow it down and add frictions where we can. And so I think it's a very long-term process for something like Bitcoin to 10x or 30x and start kind of being at the scale that would be like a completely viable power compared to the US and China and these really the biggest currency blocks in the world. But yeah, if it's able to kind of get super big, at the same time as you have kind of these long-term fiscal deficit issues really start to increasingly have their problems, and countries have to take more overt actions to try to protect their currency, things like you see in developing countries, capital controls and yield curve control and kind of this kind of yield suppression that happens. And it kind of, the mask comes off and more people flee to those assets. It can become kind of like there's two separate worlds there. And there's one that's kind of decentralized and resistant to debasement. And the other one is centralized and increasingly rapidly debasing. I guess my view is that it probably would take quite a while if we reach that phase. And Bitcoin has to be tested in pretty much every way. It's already been tested by the flurry of altcoins. It's always tested by just the long-term risk of quantum and whatever kind of fears people have around the technical sustainability of it. Right now we're obviously seeing discussions around non-monetary data in the blockchain and what, if anything, should be done about that. So it has to kind of go through almost every test imaginable. Governments have tried to ban it, and in some cases pulled the ban back, or the government's own like legal system. Sometimes you have independent courts, and there's kind of money will come in and try to challenge certain bans, and it's this long-term thing that has to go through for decades to test itself to be super viable and resilient, and then grow large enough to challenge some of these really big systems.
How do you interpret this level and the broader 4-year cycle?
So I think the 4-year cycle doesn't really make sense anymore in the sense that it used to really matter because the new supply growth was significant. And so cutting that new supply growth in half was a really big event. And so it kind of gave us a natural 4-year cycle. Now, the supply growth is so low that it doesn't really change a ton And the much bigger force is, if you raise the price, you get existing holders to sell, or some of them. There are people that bought 5, 10, 15 years ago that many of them have families now, or many of them are very wealthy in Bitcoin terms. They might want to upgrade their consumption. Some of them might want to diversify. Instead of having 95% of their net worth in Bitcoin, maybe they say, well, I'll go down to 70%. So you get this kind of unlocking of older coins that naturally happens when you have a really big price jump. And so it's kind of going through its distribution phase. I think the price action this year was a little bit on the disappointing side. I didn't like to give price targets, but when I was pressed for one, I said, I'd like to see 150. We only got up to 126 or so. So a little bit on the disappointing side. But I don't think the 4-year cycle is relevant in the sense that, just because it didn't hit certain targets this year means that people have to wait another couple of years for the next bull run. I think we're in more liquidity-driven cycles now, as well as these kind of distribution cycles that it goes through. We also, of course, this summer went through a levered treasury company, a little bit of a bubble cycle there that I think had to be kind of worked away. And that kind of took away some of the buying power that would have gone maybe directly into Bitcoin. If instead it went into like inflated MNAVs of these Bitcoin treasury companies, that literally could have been the difference between 126K Bitcoin and 150 Bitcoin or more. But that's another cycle, just like anything else. I think going forward, you have to kind of take each month, each year for what it is, rather than assume that you're kind of owed a bull market just because it's that part of the cycle. You're owed a bear market just because it's that part of the cycle. And I think that's yet another narrative that Bitcoin has to kind of shake away, and that it over time will shake away.
At the core of Lyn Alden's thesis is a simple but uncomfortable truth. The Federal Reserve is no longer operating from a position of control. Years of accumulated debt, structural deficits, demographic pressures, and political constraints mean aggressive quantitative tightening is no longer sustainable. Every attempt to meaningfully shrink the balance sheet runs into financial instability somewhere else in the system. As a result, the Fed doesn't pivot dramatically. It quietly backs away. Liquidity resumes not as stimulus, but as maintenance, keeping markets functional rather than healthy. This is why Alden describes the current environment as a gradual print rather than a sudden one. Historically, gradual liquidity regimes don't lift all assets equally. They tend to favor scarce, durable assets over long-time horizons, but they punish overvaluation and crowded trades. Unlike the explosive post-2020 environment, prices don't rise simply because money exists. Assets are still correct, rotate, and underperform for long stretches. This creates a far more selective and psychologically difficult market, one where patience matters more than timing and conviction matters more than narratives. For Bitcoin, this marks a major evolution. Supply issuance, once the dominant driver of price cycles, is no longer the main story. With most coins already mined and new issuance minimal, price is increasingly shaped by liquidity conditions, investor behavior, regulatory friction, and capital rotation. Long-term holders selling into strength, institutions managing exposure, and competing financial products all influence price action in ways the old 4-year model never accounted for. Bitcoin is no longer just responding to its own internal mechanics. It's responding to the global financial system itself. Looking ahead to 2026, the stakes are high. Bulls see an inevitable liquidity surge and renewed upside. Bears warn of prolonged stagnation, tighter regulation, and slower adoption. Alden's framework doesn't promise easy answers, but it offers clarity. If the 4-year cycle is fading, investors must focus on liquidity trends, fiscal pressure, real yields, and behavior, not halving countdowns. Bitcoin's role isn't diminishing, it's maturing, and understanding that shift may be the difference between frustration and long-term success. If you found this breakdown valuable, make sure to like the video, subscribe to the channel, and share your thoughts in the comments below. Thank you for spending part of your Christmas day with us. We truly appreciate your support. Wishing you and your family a peaceful holiday season and a successful, well-positioned year ahead.